Is real estate in a bubble, and are we headed for a crash? Should you keep your house, buy more houses, or should you sell? These are questions we're going to look at, and it's really important that what you do today, how it's going to impact your financial future. So we're going to go over it in 3 easy steps and give you a strategy you can do to take advantage of this time right now. So the first question that everyone's asking is single family real estate in a bubble, right? Is it in a bubble? Are we in a place where we're getting prices that are so high that nobody can afford it anymore? That's a very legitimate question that we're asking. Over the last 20 years, if you look at this chart, what you're going to see is that in 2001, the average price of a house in the U.S. was $169,000, and now 20 years later, it's $347,000. So that's an increase of 205%. And the question comes to why? Why has this happened? And how do you know, Bronson, that this is a bubble? And what can we do to take advantage of it? Well, it comes down to this down here. You may have heard this. And when interest rates are low, asset prices are high. And there is a relationship between interest rates and asset prices. And what that means is when interest rates are high, people can get a great return just for putting their money in a bank. I recently opened a bank account and they sent me a letter that said, your returns in this account for your interest are 0.0% per month or per year. And I was just kind of like, well, what's the point of even having your money in there? It doesn't make sense. So what happens is what a lot of people do is they'll put money into other assets. They'll put them in the stock market, they'll put them into real estate. And so what it does, a lot of people get second homes, they get investment properties, and that drives the demand and the price for real estate up. So Bronson, you're saying, yeah, okay, this happens. I get it. That's very common sense. You know, that if interest rates are high, asset prices are lower, and interest rates right now, they're low, so asset prices are higher. But how long can that go on? Can't that just go on forever? And the answer is, it is a matter of time. It can't go on forever. It goes on until there's a problem.
Houston, we have a problem.
And so I want you to take a break right now, like and subscribe to this video. I'm going to share next about the relationship a little deeper between interest rates and inflation. I think you're going to love it. All right, step number 2, we're going to talk about interest rates and inflation. And we talked a little bit about interest rates, kind of how they affect things. When interest rates are high, asset prices typically are lower. When interest rates are low, asset prices can be very high. And the reason for this is it comes down to affordability. If I have $3,000 a month to spend on a house payment and interest rates are low, I can afford a much higher asset price because interest rates are so low. Interest rates right now are low, some of the lowest interest rates that we've ever seen historically. They're just so low. And you can see this chart. It will show you exactly what that looks like, that we really can't get much lower than we're getting here now. They're talking about negative interest rates, which is kind of a crazy concept. But basically, it comes down to the issue of affordability. So if interest rates all of a sudden become higher, people can afford less of a house or less cost. So that is a deflationary pressure, which brings the price of housing down. So something to keep a note of. So with the question, Bronson, why can't we just keep the rates forever low? Why can't we do that? And we mentioned, that you saw that chart. Why can't we just keep it low? Well, there's some real reasons for this. Is when asset prices go up, it also drives the cost of other goods up as well. So if the stock market, real estate, all these assets are up, energy costs are up, other things are up. So when you go fill up at the pump, that's up. You're buying things like toothpaste and toilet paper and groceries. All those things cost more. And so this is something the Federal Reserve really keeps an eye on, because it really becomes very, very inflationary when you have strong asset prices, and you also get these cost of things that you need to buy tends to go up. So over here, if we look over here at inflation, I want to talk a bit about inflation. I did a video on inflation very recently, and I think you'll really like it. You can check it out at the link up above here. But inflation really is 2 things. It's the quantity of money times the velocity of money. So if you see this chart here, this is showing the quantity of money. We've basically, in the last 20 years, we've had a 4x increase in the supply of physical currency out there. That's a lot of money. So, just like DuckTales or Scrooge McDuck, you're going to see money, money, money everywhere. And that's what happened. So we talked about the housing prices have doubled in the last 20 years. Well, the money supply has grown even faster. It's grown 4 times over the last 20 years. So the second thing is velocity of money. So velocity of money is actually really interesting. It has to do with how much people spend versus saving and how quickly they spend the money. So, there's a metric they use that basically determines how quickly money is moving. So it was normally historically, you can see this chart, it was about 2. Right now we're at about a 1.2, which is almost half of what it was. So velocity is down. It is starting to pick up. I believe this chart is not, up to actually this month or today, but basically it's starting to pick up now. During the pandemic, it was very difficult to spend money and go do things, but velocity of money is picking up. So inflation is starting to rear its ugly head. And okay, so Bronson, we're talking about single family housing. Why do you keep talking about inflation? Why are you talking about interest rates? Why are you talking about all the stuff that really doesn't seem to make sense directly to housing? But I would say it actually directly relates to how much your house is worth, the houses that you own, whether you should buy homes. And the reason, like I said before, is if things catch on fire, meaning inflation picks up. Shadow Stats says we're at 14% inflation now. We could be 5.4%. It could be transitory, but it's getting higher. And eventually what happens is this fire picks up. Everything starts costing more. Assets, things you need to buy. The Federal Reserve says we need to throw water on this fire. We need to put it out. And they've said that they are not going to raise interest rates until at least 2023. And I don't think that is feasible. I don't think it's reliable. I think the reason they're saying this is they don't want to cause a panic. But really, interest rates could rise pretty quickly. And the reason they do that is to try to tame inflation. So it brings asset prices down. It may bring spending down. And you basically, now things change. So again, when the price of a loan or the interest rates go up, you have less affordability. We talked about affordability. It's all about affordability. So if somebody can't afford to buy your house, or that same $3,000 that they have only gets them, instead of $1 million house, or let's say I'm in Southern California, it gets them let's see, I guess $5,000 a month would get you $1 million house maybe, and then you get down to $500,000. It has to reduce the amount that you end up buying. So just to clarify. It's really important that we keep an eye on this, and the question really comes down to is what is it that you should do today? And we're going to talk about that. All right, so step number 3 is to weather the storm and buy and hold long. So in the words of my friend George W. Bush, you have to use your strategery to try to make the best decision. So I love that word. It's not a real world word, but I love it, strategery. And so what is it? What's the strategery or the strategy that you want to use in order to protect and grow your wealth, especially if you have resources? So the single family market, what I believe is going to happen is in the next couple of years, we're going to have a depression in asset prices. We're going to have a drop of 20 to 35% because interest rates will rise, affordability will go down. We may even have a recession. This will be somewhat temporary. It will not last forever. It may last for several years, 3, 4, 5 years. Inflation right now, we said, depending on who you talk to, it's between 5.4% and it's transitory. It may completely go away. Or if you talk to Shadow Stats, it's 14% currently. So it's probably somewhere in that range. It's continuing to head down there. The Fed is going to have to take action sooner than 2023. So right now, the biggest thing that you can do, the strategy you can do, is you can take advantage of long-term debt. So if you can get a 30-year fixed mortgage on a house, it's still not a bad idea to buy when asset prices are considerably high, right? Interest rates are low, asset prices are high. But if the mortgage, a 30-year mortgage, I put 10 to 30 years because we'll talk about the 10-year in a minute, but a 30-year mortgage, inflation starts to pick up. There's more money printing. Prices depress, but over the long run, because of all the money printed, it becomes a very valuable investment, and we may never see interest rates like this again. So you can do single family portfolio investing. We find that most people that do single family, myself included, don't actually get to financial freedom. Often we undervalue our time. So you can either do that or you can not do that. I've actually got a video that talks up here about why single family investing does not work. And it has to do with just the amount of time you put into it and also some of the volatility of the asset as well. What we do is we do multifamily investing. So we buy an apartment building. There's a lot of benefits to that. You can do that yourself. You can invest passively in groups like ours or other groups. And basically there's incredible tax benefits. You get a lot of inflation hedge protection during times of recession. If you buy in the right markets, they tend to do very well. So you can check out this video that talks about multifamily investing. But I want to know from you, what do you think about the single family housing market or the housing market in general? Are we in a bubble? Well, what are you doing to protect yourself so that you grow and preserve your wealth during this time. So write that in the comments below. We'll look forward to seeing you on the next video.